I'm Louis from CCF Group. Today, I'd like to share with you a broader picture of China's toluene and the mixed xylenes market in 2026. And let's first begin with a review over the market in the first half of the year. The US and Iran conflict broke out in the end of February 2026, and then Iran announced to close the Strait of Hormuz on March the 4th, right after the military strikes started. Since then, the critical waterway has seen repeated closures, intermittent restrictions, blockade, and attacks on commercial ships amid the ongoing conflict. As a result, crude oil supply from the Middle East was disrupted and the price shot up in early March. Brent crude futures surged from about $72 per barrel in the end of February straight to $98 per barrel on March the 9th. That's a jump of 36%. In China, because of raw material supply disruption fears, Chinese yuan toluene and MX prices went up even faster, increasing by 55% and 46% respectively over the same period. At that point, the geopolitical risk premium was really the biggest driver to the price movement. But as the geopolitical risk premium began to fade, China's toluene and MX prices followed the pullback in crude oil prices. US Gulf market, however, was relatively resilient and prices hovered on the high side. That's because the summer gasoline demand peak in the US was around the corner, and it supported prices of blending components to move independently from crude oil in the US. In China, though, demand remained pretty weak, and the market underperformed its overseas counterparts. If we look at the overall profitability of refineries, we can find that it was under high cost pressure in the first half year. This slide shows a rough calculation of average refining margin for China's state-owned and teapot refineries, and the yellow lines show the trend for the first half of this year. The losses for refineries kept worsening for both state-owned and teapot refineries in China, and the margins became quite volatile compared to the previous years. Refining margins started strong in the beginning of this year, but then weakened, and the decline accelerated, especially in the second quarter because crude oil price spiked and the supply was in shortage. State-owned and teapot refineries saw margins move at different paces. Teapot refineries were more sensitive to raw material change and reacted faster to crude oil price surge and supply shortage. But the overall direction was the same. Both of the margins were squeezed. But we did see some temporary improvements in the margins, but the recovery remained quite limited on overall basis. That's a big picture for the refining margins. As a result, we can see operating rates for both state-owned and independent refineries in China began to decline from March this year and kept falling through the end of June. There were two main reasons. Firstly, as crude oil price surged and supply tightened, China's refineries saw a worsening of profitability, as we just talked about. And secondly, the second quarter was typically the maintenance season for Chinese refineries, and therefore the combination of the two pushed the overall operating rates down. State-owned refinery operating rates actually increased in January to February this year, but then dropped from 83% in early March to 68% in end of June. Teapot rate fell steadily from 63% in the start of the year to 42% in the end of June, as we can see from the charts on this slide. The yellow lines shows the trend for this year. So as a result, the operating rates of Toluene and MX in China also hit the record lows. So if we look at China's Toluene and MX operating rates in the first half of this year, both of them bottomed at historical lows. And CCF Group data shows that from the end of February to the end of June, Toluene operating rates dropped from 84% down to 65%. And MX followed a similar path from about 84.7% down to 95.8%. So both saw pretty significant declines over that period, as we can see from the chart on this slide. The green lines show the trend for this year, and there's a comparison with previous years. What drove that? Well, there are mainly two things. First, crude oil prices were running high, pushing up feedstock costs. And at the same time, downstream demand remained weak. So with high costs and weak demand, refinery margins got squeezed really hard, and that forced a lot of plants to cut production. Then let's shift our focus now to the demand side. Let's take a look at how the demand for toluene and MX actually performed in the first half year. First of all, let's talk about gasoline, because nearly half of China's toluene and MX go into gasoline blending as blend stocks. So whatever happens in the gasoline market, it's going to have a pretty big knock-on effect on toluene and MX prices. But before we look into it, there's some background we need to share. Over the past few years, China's refined oil market has been going through some major structural changes. The biggest one is the rapid rise of new energy vehicles. Electric vehicle sales have been climbing fast, and that's been putting real pressure on gasoline consumption. And that substitution trend isn't going away. It keeps eroding the demand for blend stocks as well. And at the same time, the government has been guiding and pushing refineries to switch from oil products and shift toward the production of chemicals. It's a policy direction. So when you put those two forces together, there's one clear outcome. China's demand for refined oil has been on a steady downward trend. But looking outside China, there's still some demand from the US for high-octane blending components, but the volume has dropped, and the peak windows are getting shorter. It's not what it used to be. The demand cannot compare to the boom times we saw back in 2022 and 2023. So on the whole, if we look at big picture, the support that blending demand used to provide for toluene and MX has been gradually weakening over the past few years. It's still there, but it's definitely not as strong as it once was. Then let's start with the first chart. It shows the gasoline to MX price spread in East China during the first half of this year. In fact, the spread started narrowing sharply back in April, and it stayed pretty low through April and May. That means if a refinery bought toluene or MX to blend into gasoline, the economics just doesn't look good. Margins got squeezed pretty hard, so naturally, blenders did not show much intention in buying toluene and MX. Their interest just faded. Now, if we look at the second chart on this slide, you can see China's gasoline production actually dropped quite a bit from April to June compared to the same period in previous years, and the yellow line shows the trend for this year. But why? I think there are two main reasons. First, there was a lot of refinery maintenance going on in the second quarter, so output took a hit. And secondly, overall demand for refined oil was weak, so refineries just didn't have much incentive to ramp up production. And when gasoline output goes down, that directly means less demand for toluene and MX as blended stocks. That is simple as that. Now let's move to the third chart. It's gasoline exports. This year, exports have been tightly controlled. For example, there was a ban on exports back in March, and that really catch the export of toluene from China. And let's look at the numbers. From January to May last year, gasoline exports were 3.11 million tons, but in the same period of this year, the amount was only 1.2 million tons. That's a huge drop. Exports were almost at a standstill, especially in April and May. And that sharp drop in exports also hit blending demand hard, because less gasoline going overseas means less need for blending components like toluene and MX. So, in a conclusion, in the first half of this year, blending demand for toluene and MX was pretty soft. The narrow spread squeezed blending margins. Export restrictions held back blending activity, and all of that combined led to that commercial gasoline stocks in China actually built up during the first half of this year. So next up, let's move to the demand for toluene and MX from PX sector. In the first half of this year, PX producers who were using MX as supplementary feedstock actually saw pretty good margins. If you look at the chart on the left, the line here shows the processing spread between PX and MX in Chinese yuan, based on CFR China PX price and East China Yuan MX price. The yellow line shows the trend for this year, and you can see it's been running above where it was last year. For the first half year, that spread averaged over 700 yuan per ton, and it even once spiked to 2,000 yuan per ton, which is way higher than what we've seen in previous years. If you trace it back, this upward trend actually started picking up in the fourth quarter of 2025, and by the end of 2025, the spread was already looking pretty attractive for PX units. So there's a question why? Why did it start to go up from the fourth quarter of 2025? Firstly, on the supply side, China actually saw a pretty notable increase in toluene and MX output at that time, thanks to some new units coming online, especially after Yulong Petrochemical started up its second reformer in August 2025. But here's the thing. Blending demand was weak, and overall downstream consumption just wasn't enough. However, the PX market didn't see any new capacity during that same period. In fact, there hasn't been any new PX units in 2024 or 2025. So that left PX with relatively healthy fundamentals, and that's what drove the PX and MX price spread higher. Now, if we look at the demand for MX from PX units, it was actually pretty decent overall from January through May this year. Though the chart on the right side shows that China's PX operating rates took a big dip, but in the earlier months, the PX units that rely on purchased MX weren't really affected. Most of the shutdowns didn't happen until June. And those plants we are talking about here include Sinopec Hainan, Wuhaichuang, and Shenhong. Those PX units were those PX units all went offline and later in the second quarter. However, there's actually a ceiling to how much demand for MX these PX units can generate. Even when they are running at full capacity, their MX consumption has pretty much reached maximum. There's not much room for further growth, and since we haven't seen any new PX plants coming up in previous years, there's really no substantial expansion in MX demand coming from this sector. And like I mentioned earlier, blending demand has been sluggish all along, so relying only on the PX side to boost toluene and MX demand, that's just not enough. And looking ahead, if we want to see any real improvement in toluene and MX demand, it's going to depend on when new PX capacity will come on stream, and it will be in the first half of next year if those projects actually move forward. Next, let's move on to the TDP demand. That's a process where toluene gets converted into benzene and MX. If we look at the chart on the left, it shows the prices of toluene, benzene, and MX in East China from 2024 to 2026, all in yuan per ton. From 2024 through the first half of 2025, prices initially moved up but then came back down. Back then, benzene was trading at pretty much higher than toluene, but from the second half of 2025 onwards, you can clearly see prices started trending lower, and as a result, the spreads, both benzene to toluene and MX to toluene, got squeezed pretty hard. You can see that narrowing trend started as early as the second half of 2025, and from the second half of 2025 right through to now, TDP units have been running at a slight loss for the most of the time. So not surprisingly, because of those poor economics, some planned new TDP projects have been delayed in China. Now here's one important point. Most TDP units in China are not standalone facilities, but usually integrated with PX production units in a combined system. So producers tend to look at the overall picture. They evaluate TDP margins and MX and PX margins together. And as we mentioned earlier, the MX and PX spread has been pretty healthy this year. So on a combined basis, the overall profitability is still decent. But for those of the new TDP units that are expected to come online later, they are standalone ones and don't have an MX to PX unit attached. They would have to rely entirely on buying toluene and turning it into MX and benzene. For those standalone players, if this poor margin persists, they could be under real pressure. So there's definitely some uncertainty around when those units will actually start up. Alright, now let's quickly go over China's toluene exports and MX imports in the first half of 2026. Let's start with toluene exports first. In recent years, China's toluene capacity has been expanding steadily as new plants kept coming online, and China's domestic output has been gradually rising as well. But as we mentioned earlier, the tolling sector is facing some real challenges on the demand side. One is that gasoline consumption is being hit by energy substitution due to the rise of electric vehicles. And the other is that TDP economics are pretty weak right now. Both of them have actually led to a relatively loose supply-demand balance in China's tolling market. However, seasonal blending demand from Southeast Asia has been stable, and chemical demand from India continues to hold up well. So with China domestic supply growing but overseas demand staying healthy, the economics for exporting toluene have actually been improving. Over the past few years, China's toluene exports have shown a clear upward trend year by year, and in 2026, that pace is expected to accelerate even further. Now, in the first half of this year, because of geopolitical tensions in the Middle East and the blockade of the Strait, a number of refineries in Japan and South Korea were forced to cut run rates or even shut down entirely due to feedstock shortages. So outside China, toluene and MX operating rates dropped and supply tightened. As a result, US dollar-denominated prices shot up faster than the gains in yuan-denominated prices, and it led to a rapid widening of the price spread. That made exporting toluene from China pretty attractive from a profitability standpoint. If you look at the first chart, you can see that export profits started climbing from this March onwards. The spread between FOB China prices and domestic yuan prices even hit nearly 1,000 yuan per ton in early March. It did narrow a bit later on, but the profit level has remained fairly decent. And if we turn to the chart on the right, we can see that China's toluene exports increased significantly in the first 5 months of this year, reaching a total of 590,000 tons, way up from 320,000 tons during the same period last year. That's actually a record high for this time of year. The strong exports have also helped effectively ease the oversupply situation in China's domestic market, and they've become an important source of demand support in the first half. As for where all this touring is going, the main destinations are South Korea, Singapore, Malaysia, and a few others, driven by both blending demand and chemical demand overseas. While China's toluene exports were going up, the MX imports have been on a steady decline since 2025, with a bunch of new plants starting up domestically. Local supply has ramped up significantly. But at the same time, demand for blending components have been shrinking, and there haven't been any new PX units in recent years. So consumption just hasn't had much room to grow. So with supply rising but demand weakening, China's domestic MX market has also turned quite loose in supply. And you can see from the chart on the right side that since around the middle of last year, MX import volumes have been on a downward trend, and in 2026, that decline really accelerated further, as the yellow bars on the chart show. Since the start of this year, China domestic yuan-denominated MX prices have been sitting below CFR China prices for long, and the spread has widened in negative territories, which basically means the upchart window for imports is shut. At the same time, markets outside China were also hit by geopolitical tensions and low operating rates at some refineries. So MX availability outside China was pretty tight, keeping USD prices on the high side. And with high prices comes low competitiveness. So with ample supply at home and a tight supply abroad, China's MX imports kept falling through the first half of 2026. From January to May this year, total imports came in at just 130,000 tons. That's a massive 75% drop from 530,000 tons during the same period last year, and that also marked a record low for this time of year. As for MX exports, there are actually quite a few hurdles, so the volume is pretty limited. First of all, China's toluene exports benefit from the tax rebate policy, which gives them a bit price edge in the international market. But MX doesn't get that same treatment. There's no tax rebate for MX, so the export cost ends up being relatively high, and it's hard for Chinese MX to compete on the price. And there's another issue. China's customs has pretty strict quality requirements for MX. They have clear specifications on the content indicators. So the thing is, some of China's domestic supply just doesn't meet those export standards. So that further restricts how much we can actually ship out. So all in all, between the cost advantage and the quality constraints, MX exports were going to stay limited. Now let's look at the price gap between Asia and the US market. In the first half of this year, the spread for both toluene and MX kept widening if we compare FOB US Gulf and FOB Korea prices. For toluene, the spread went from about $100 per ton in early April all the way up to 400 or 500 to 400 to $500 per ton by June. And for MX, it expanded from $100 per ton to around 300 to $350 per ton over the same period, with US prices sitting way above Asian levels. So what drove that? The main reason was seasonal gasoline blending demand in the US, especially with the peak driving season kicking off from late May. Now, if we look back to what happened in early to mid-June, there was an expectation that Strait of Hormuz blockade would, would ease at that time, which would bring more naphtha supply back into Asia. But at the same time, Asia naphtha crackers were running at low rates because olefin economics weren't great. So there was this situation that naphtha supply in Asia was expected to pick up, but demand remained weak. As a result, the naphtha price spread between Asia and the US narrowed sharply, and that reduced the flow of naphtha from the US to Asia. With fewer naphtha exports leaving the US, the local market turned oversupplied. Some of that excessive supply got diverted into the US gasoline pool. But here's one thing, that naphtha doesn't have the octane rating that gasoline needs, so that actually created a stronger demand for high-octane blending components in the US, and toluene turned out to be a more ideal choice. And that's exactly why the US and Asia spread for toluene widened more than it did for MX in the first half year, because toluene was a preferred blending component in the US. Now let's talk about how the price spread actually impacts export flows. Specifically, let's look at South Korea's toluene and MX exports to the US. In the first half a year, South Korea shipped out about 89,000 tons of toluene to the US, up from 52 tons in the same period last year. But for MX, the picture was totally different. Exports came in just 16,000 tons. That's a huge drop from 172,000 tons a year earlier. The charts here show the monthly export figures. From January through April, the spread wasn't wide enough to make the arbitrage work, so there just wasn't enough profit incentive to ship cargoes across the Pacific. But things changed in May and June. The spread widened. and we started to see some South Korean toluene and MX cargoes gradually heading to the US market. Right now, the spread is still at a decent level, so the upcharge window remains open. However, we do have to keep in mind that the shipping takes about 2 or 3 months. That means cargoes loaded in the third quarter won't arrive until the end of the quarter or even later, by which time US demand typically fades. So the third quarter is usually the off-season for South Korean exports to the US. And we expect Asian toluene and MX exports to the US to be fairly limited in the third quarter. Alright, let's quickly review the first half of this year. China's toluene and MX markets in the first half were largely driven by higher crude oil costs. But at the same time, they were held back by weak supply and demand fundamentals. On the cost side, international crude prices surged and supply got disrupted because of the geopolitical conflict. Toluene and MX largely followed Crude's moves. Rising costs were actually the biggest driver behind the price movements for much of the time. Now, on a fundamental, China saw a big jump in toluene and MX capacity last year, with new plants coming online and output increasing as well. However, in the first half of this year, operating rates for both toluene and MX dropped notably, as refineries were running at losses due to raw material disruptions. So output did shrink, but demand was even weaker. On the blending side, China's gasoline consumption was sluggish, hit by both electric vehicle substitution and restricted exports. So toluene and MX didn't get much support from gasoline blending demand. On the chemical side, demand from the PX sector was actually healthy, but the consumption of MX had pretty much hit its ceiling, and since there's been no new PX capacity in China, there was no new demand growth from that sector for MX. So it just couldn't make up for the decline in blending demand. Now, when we compare the two, toluene actually performed relatively better than MX. But why? Because China's export margins for toluene were good, and exports hit a record high. It helped relieve some of the oversupply pressure in the domestic market in China. But MX relies much more on domestic demand, so the pressure on MX was much more obvious. For the last part, let's look at what's coming up in terms of new capacity in China for the second half of this year. In July, CNPC Dushanzi started up its new cracker, and then we are expecting some more TDP units to come online in the third quarter. Moving to September and October, the big Fujian Gulei and Huajin Aramco are both scheduled to start up their new units. And then in the fourth quarter, Sinopec Guangzhou is likely to bring its new reformer online. But here's the thing, whether those TDP units actually start up on time will really depend on profitability. And as we discussed earlier, margins have been pretty poor in the first half, and we've already seen some delays. Now, even with all the new unit capacity to come, the actual increase in merchant toluene supply available to the market may be quite limited. Take Huajin Aramco for example. Once it starts up, it's likely to prioritize using its toluene for its own captive downstream operations rather than selling it into the market. The same goes for MX. Even though we are seeing a lot of new capacity coming up, the supply increase could also be constrained. Huajin Aramco has a new PX unit coming online as well, and when that starts up, it may actually need to buy additional MX from the market to supplement its own supply. So because of both profitability constraints and a captive downstream consumption, the increase in toluene and MX supply available to the market could be quite limited. Now, looking ahead, we are expecting quite a few plants to come back online after maintenance. Actually, this started back in March when several refineries cut their run rates as a precaution, especially some of the crackers, which were hit by higher feedstock costs and squeezed margins. Then in April and May, we saw a number of plants go into maintenance shutdowns, including Zhoushan Petrochemical, Sinopec Yangzi, and Zhongjing. And in June, even more refineries joined the list. Sinopec Hainan, Fuhaichuang, William Chemical, Shenhong, and Hongren all shut down for overhauls, as shown in the list on this slide. As a result, the industry's average operating rate dropped to its lowest level of the year. But based on current restart schedules, we expect those plants to come back online intensively starting from July. In fact, Zhoushan Petrochemical and Fuhaichuang have already begun restarting in late July and early August. In August, we are looking at Zhongjing, William Chemical, and Shenhong. They are all expected to restart in early to mid-August. And in September, Sinopec Yangzi and Sinopec Hainan are set to resume operations. By then, we expect the industry's average operating rate to recover back to normal levels. Finally, let's look at the demand outlook from the PX sector. Most of the refineries we just mentioned that went into maintenance, they're actually equipped with PX units. So when those refineries restart, they'll need to start buying MX to supplement feedstock again to feed those PX units. But here's the thing, most of these restarts are happening in the third quarter, so we are not going to see a sudden surge in MX demand. It's going to be gradual, and in fact, we don't expect demand to fully recover until September. Looking ahead to the fourth quarter, once all those plants are running steadily and smoothly, then we should see MX demand from the PX sector returning to normal levels. But as there could be no new PX capacity online in the second half year, the demand upside for MX will be capped, and the support to MX will be weak. So to sum up the supply and demand outlook for the second half year, on the supply side, yes, we do have several new units expected to start up, but the actual increase in supply hitting the market could be fairly limited because a lot of that output will be consumed internally by captive downstream units. At the same time, we are seeing plants coming back online starting from late July, and operating rates are expected to keep recovering through August and September. But this isn't going to happen suddenly. It's going to be gradual for supply to recover. Looking ahead to the fourth quarter, once plant operations stabilize, we expect supply to stay fairly steady. But on the demand side, it's a bit of mixed. Most PX plants should be back online by then, so demand for MX will recover gradually. That part of demand will be still weak in the third quarter with PX units still restarting, but substantial demand recovery is expected in the fourth quarter. Now, on the blending side, the third quarter is typically the peak season for blending activity, so toluene and MX should get some support from that. But once we move into the fourth quarter, the summer driving season winds down, and that blending support will start to fade. As for toluene exports, we expect the export margin to remain attractive given that China's domestic supply is ample while overseas supply stays tight. So toluene exports will continue to serve as a relief for China's domestic oversupply in the second half year. And that's all I have for my presentation. That's all I have for my presentation. Thank you for your time and attention.